There's always a good time to be talking about international markets, but 2017 may be the best so far. We've had an interesting H1. We're looking at one of the best periods of synchronized global growth of developed and emerging economies in a decade, but a lot of geopolitical risk on the horizons. Can you give us a little bit of a sense of how you contextualize this?
So pretty much in line with Klaus and Mike with a slight twist, if you will. So we echo the view of a growing, recovering Europe finally. Europe had suffered a decade long of effectively a contraction in economic activity, in a rise in unemployment. Europe almost dipped into a deep deflationary spin. Luckily, it's emerging out of it. Mario Draghi, the ECB's president, recently shifted his concern from deflationary pressures to inflationary. We're seeing economists at large revise Europe's outlook from 0.5% GDP growth to 1.5 plus. In the meantime, the U.S. is more likely to grow, or is expected to grow, at a 2%, not the 3 or 4% that the market had anticipated back in November around election time. More importantly, we are seeing a resurgence in corporate profitability. As a matter of fact, Europe has had its best quarter in 7 years. Over the past 8 months, European corporate earnings have been revised upwards. Likewise, we're seeing a pickup in economic momentum in emerging markets. As Mike had mentioned, on the commodity front, yes, there are those that produce and rely on commodities for revenue. However, oil has already dropped from a peak of 130 plus to the mid 40s. So that headwind has already taken place. Likewise, in industrial commodities, be it iron ore and or copper, aluminum, and as Klaus had mentioned, China continues to navigate well through fiscal stimulus. We're seeing China's construction and housing, particularly in tier 1 and tier 2 cities, if you will, inventory turnover, that's the sales volume to the existing inventory, is picking up.
Well, the world really panicked, or the headlines panicked, when China was making those movements in its currency. So do you think that we may have miscalculated what China was trying to do there?
So our view on the Chinese currency, and I'm not a macroeconomist. I'm not. If anything, the renminbi or the yuan was trading a bit rich, particularly as the rest of the world embarked on stimulus, on QE, depreciating their currencies. On a relative basis, China held its currency constant, and China has been gradually navigating that shift from a pegged to a managed to eventually a free floating. But make no mistake, they are committed to opening up their capital system, and we're beginning to see that recognized, like the inclusion of the renminbi in the SDRs, and more recently the acceptance of Chinese equities, A shares, into the MSCI Emerging Markets Index.
Can you give us a little bit of an outlook on where you see global monetary policy moving?
So indeed, the UK and the Bank of England is in a tough bind. They are trying to navigate Brexit, the UK's, United Kingdom's exit out of the European Union, economic union. And in so doing, Carney embarked on fiscal stimulus, cutting rates, and quantitative easing with full force, which led to the pound sterling depreciation. That indeed led to imported inflation. The UK is a large importer of most goods consumed within the islands. Now, having said that, what's happening now is that wages within the UK have not kept a pace with inflation. There's been a rise of wages, but not at the same magnitude as CPI. So this is leading the consumer to feel a drop in discretionary capacity and retrenching on spending. To fend this off, the UK's Bank of England is signaling to the market the beginning of the end, if you will, in terms of monetary easing, not fiscal easing. And they still have to contend with exiting that union and the possibility or the advent of a hard exit, while has a lower probability now post the recent election held and the loss of the Conservatives' majority would allow for a more negotiated and hopefully the UK exits to some deal rather than no deal. But it's yet to be seen, and we're seeing that the French, particularly the new President Macron, is competing fiercely for the all too important financial services which resides in London.
Talk to me a little bit about some of the world's major currencies, not necessarily a hard forecast, but when you look at the euro, the dollar, the pound, what are you expecting moving forward this year?
It is in Europe's broad interest to have a healthy UK and a healthy UK economy. However, for the Eurozone and the European Union remaining, the 27 remaining, I think the Germans and the French are going to make sure that the experience of the UK, that the UK are worse off outside of the European Union than they have been within it. Otherwise, that would pave the way for other members to follow suit.
Now, when you think a little bit about investor positioning and sentiment going forward, and obviously we can break it down market by market, how do you think that investors, generally speaking, are feeling about allocating abroad? And do you find that, for example, I recently read that the European economy is having its highest bout of good sentiment in a decade. So when you think of it that way, do you think we're going to continue to see more asset flows there?
Indeed, we do, and it's not just sentiment. It's actually taking place in the underlying economy, in the underlying fundamentals of companies. So Europe in particular suffered 4 major headwinds over the past decade, not least of which is political uncertainty, which is getting resolved one piece at a time. The UK indeed voted for the Brexit. The Italian referendum took place. Marine Le Pen is behind us. Angela Merkel has picked up popularity. If anything, she's becoming the global leading leader. So that risk or uncertainty surrounding the Eurozone is abating. Second, we've discussed commodities, the decline, the drop in commodities. European companies, UK companies are quite exposed to energy, to mining companies, to chemicals companies and industrial companies. They've already suffered a decade worth of declining earnings. Third, we've touched on interest rates and in the advent of deflation and zero interest rates. This has wreaked havoc to the banking sector within Europe. And finally, exposure to emerging markets. European companies generate roughly 30% of their revenues from the emerging world. Some of the companies we hold in our strategy, in our portfolio, like Sanofi, like Banco Santander, like Standard Chartered, generate over 50% of their revenues from emerging markets. So as these political headwinds abate, the zero rates turn into positive and the yield curve steepens, and emerging markets continue to do well. And domestically, countries like Germany are doing extremely well. Unemployment is at a 30-year low. Confidence is high. Housing is booming. Construction is booming. Yet the valuation continues to lag massively behind that of the U.S.
Safa, you're interested in Europe, so when we think about value versus growth or other factors like cyclical versus defensive, where are we right now and where are you seeing specific opportunities?
Yes, so on the valuation, I wanted to add one point to the comparison that Klaus made on the US trading on 18 times forward, while Europe or the developed world is on 14, 15 times. On a cyclically adjusted PE basis, the US is on 30 times, while Europe is on 19 times. And the point I'm trying to drive here, what gets missed often is the E in the PE ratio. There's a numerator and a denominator. Within the US, when you're looking at a 18 times multiple, the E, the earnings sit now a rich 30% above pre-crisis peak. So our economy, our corporate profits have fully recovered and then some. In the meantime, when we compare the US to Europe, the E, the earnings, continue to sit at 30% below pre-crisis peak. And we're actually observing a nadir, a turn in corporate earnings. As to your question on the value versus growth, the cyclicals versus defensives, and they're synonymous. And what do I mean by that? We're finding far more value in the cyclical side of the market. So in financials, in industrial companies, in materials, and in discretionary. Less so in food, in tobacco, in alcohol, in biotechs, and everything internet or media. I want to include China, which is today the second largest economy. And the Chinese market has two types of shares. There's the H-listed shares, which trade outside of China, and then the A-listed shares. Just the last 12 months, the NASDAQ and the H-listed shares, so names like Alibaba, Baidu, Tencent, are up. That basket is up 30%, over 30%, while the domestic names, the A shares, are up 9%. So a massive spread, not unlike the US market. If you look at the Facebooks, the Googles, the Apples, massive outperformance to the rest of the market. So where are we finding value? It is in the cyclicals, it is in the financials, it is in industrial and mining companies. And why are we excited? European banks have healed, they've recapitalized. We've been through numerous rounds of capital raising. They've delevered. They've written non-performing loans down. They've provided for them. They've consolidated. And we're seeing early stages of pickup in demand as the yield curve begins to steepen. So we're getting the perfect tailwinds here. Likewise, the Rio Tintos, the Anglo-Americans, the profligate decade of spending without any discretion is over. These companies have focused on driving efficiency, on driving productivity, sweating their assets much more effectively, improving their balance sheet, paying down debt, returning capital to shareholders, and improving returns. And the valuation continues. And guess what? China is investment has not come to a halt. In Europe, CapEx is at a 30-year low. Klaus talked about the spreading of wealth. Greece, Portugal, Italy, they cannot grow if they don't invest in infrastructure, in telecom, and so on. So we're seeing a pickup in CapEx as well. So we are far more interested in the cyclical, the value side of the market, if you will, than the defensives, the bond proxies.
Let's talk about Brazil for a moment, because we have seen Lula da Silva's picture all over the television today. Obviously, he's just been charged in corruption in Operation Car Wash. We've also seen Rousseff and Temer taken down by the same corruption probe. Do you think that these political headwinds will really slow down the economic growth in Brazil?
So let's separate fact from fiction. So the car wash corruption scandal. It's now a decade long. Rousseff has already been impeached. Lula got a jail term this morning, which is not likely that he will serve. But more importantly, he will not get to run in next year's elections. The most important fact that's getting lost here is Michel Temer, the sitting president that took over from Rousseff, is reforming the economy. He's already legislated for transport and energy reforms. We're pretty close to getting a labor deal done. We're pretty close to reforming pension benefits. These things have saddled the economy. Furthermore, Brazil's economy is recovering. Inflation is declining. We talked about commodities prices, so iron ore, energy have already collapsed. Brazilian economy is a large consuming economy, roughly 185 to 190 million people, relatively healthy demographics, young in their prime spending years. And the economy is quite diversified in terms of agriculture, commodities, etc. And we see very attractive valuation in names like Itaú, which is Brazil's largest bank, very prudently managed, very much navigated the crisis well. Another name, which is a payment processor, Cielo, is the Visa of Brazil. So as the economy heals, expenditures improve, Brazil is on the mend. And it continues to trade on a very attractive multiple. So Brazil has declined annually about 2% in US dollar terms. And you got to unbundle the currency because the Brazilian real got hit pretty hard. And it now trades on 11 times depressed earnings, yet it has the long-term growth profile.
Let's talk a bit about China. Constant clamor for a property bubble. The questions over the devaluation of the currency, markets really reacted strongly, even if they were just small technical movements, as the Chinese government has insisted. What do you think the outcome for China looks like?
It's too large an economy today, the second largest economy in the world after the U.S. At 9.5, $10 trillion, at 6%, rough math, that's $600 billion. That's larger than a lot of, smaller economies. That's the incremental output. China's per capita GDP is also rising. There's definitely a shift in focus from capital investment to drive consumption. So wealth will be created, and there are definitely opportunities. But there will always be challenges when you're shifting an economy from a fixed asset export-led to a domestic consumption-led. Now, they have the advantage of not being a democracy. Unlike India, if you want to put a highway through in China, you just do it. It just happens, which allows you to build the infrastructure necessary to develop your economy. And they're also shifting from low economic value added, from making jeans and toys to the world to manufacturing smartphones and aeroplanes and automobiles and electric vehicles, etc. Their intellectual property is also on the rise.
And buying a lot of German advanced manufacturing companies.
Yes. Indeed. Actually, some of the European companies that we invest in, the middle shot, the small and medium-sized enterprise, and that's part of why Germany has a current account surplus, because virtually no one competes with these companies that make machineries and tools that go into factories. We talked about automation and so on, and driving efficiency. We are seeing this happening. There will be winners, there will be losers, and China is just too large and too powerful of a growth engine to completely dismiss out of a portfolio.
I want to talk about the methods by which we invest internationally. And I just hosted an ETF Masterclass yesterday, and we looked at the inflows into ETFs. And it would be a record year if it was a year, but it's only the first half of 2017. So an enormous shift toward passive. When you look at active versus passive in an international context, how do you think about it?
Before I answer the question on the currency, if I may, I'd like to make 2 points on the active versus passive debate. Now, at the risk of sounding self-serving, because we are an active manager, it's important to understand what's driven this flight to passive, or if you will, the passive outperformance. The number one reason is central banks. The Fed, the ECB, the Bank of England, the Bank of Japan, cutting rates. In cutting rates, they inflated asset prices, all assets. Asset pricing has been distorted. And accordingly, the more rates you cut, the more the value of these future cash flows rises, and the more it chases it. These passive strategies, whether they're market cap weighted or momentum tilted, they tend to chase performance. So it becomes a self-fulfilling prophecy. So understanding that, and then understanding that we are very close, if not fully, in the end of the rate cutting phase. So that regime for passive is likely over. So that would be my first point against passive at this stage.
Sure, financial engineering becomes much harder.
Yes, indeed. If anything, within the U.S., buybacks has been a major source of earnings growth. And again, I'm not going to call it an end to buybacks, but we've probably seen the peak in buybacks. The second point I wanted to make is if you disentangle share prices, more importantly, share price volatility, which has been very muted because the market have seen only one side of volatility, versus underlying cash flow volatility. Business fundamentals are far less volatile than share prices. Therefore, there is a very good probability, a sizable probability, that an active manager can capture these cash flows when they're trading at a deep discount to their fair value. And again, this central banking regime shift is going to enable us to do that. If you look at the valuation dispersion within markets, particularly in the US, there's a crowding effect. You'll see the loved companies, the internet companies, the defensive companies, the companies that have growth in a low growth world are very loved and very dearly valued, and everything else is distorted in its valuation. And again, the relationship is too spread too far wide, and it's likely to revert. So if I may, let me turn to the currency question.
Sure.
As clearly, holding assets that are denominated in non-US dollars for a US investor, the currency is a very important component of the returns that they generate. We think that the Fed's gradualism is going to mean the US dollar appreciation is going to be very, very gradual. In the meantime, as Europe and as EM economies pick up, and as Mike had mentioned earlier, the QE program begins its taper, the euro appreciates. So, and as Klaus had mentioned earlier, we're in the early stages of rising rates. Rates are rising because it's the end of deflation. Imagine the ECB discussing further deflationary risks versus the end of deflationary risk, which means the economy is robust, taper kicks in. The currencies already went, the euro went from $1.48 to $1.08. We're sitting at $1.14. So what are you going to get by allocating capital to the non-US markets? You're going to get lower valuation, improving earnings, low multiples, or if you will, elevated risk premia that's going to decline, and then you're gonna hold a foreign denominated asset where the currency is going to appreciate.
So a pretty rosy picture.
It's a pretty positive picture after a decade long of tough times.
Excellent. Well, we're coming toward the end of our discussion, so I really want to give you each an opportunity to just share with us some brief closing remarks on what you think any advisor watching this program should be thinking about when they're allocating internationally in this current era of synchronous global growth.
So just a longer term perspective. Back in 2008, March of 2009, the capital markets low, if you will. The U.S. market had a market cap of roughly $14 trillion, almost bang in line with GDP. So the U.S. was trading on 1 times GDP. This measure tends to be quite stable over time. Europe had a similar profile, 15 trillion GDP, 14 trillion market cap. Roll forward to the current valuation. So the US market cap is $22 trillion. We're trading on roughly 1.5 times GDP. Europe is trading on 0.8 times capital market to GDP. I'm not going to tell you turn 70-30 non-US, but having that home bias of over-allocating to the US has served you very well. But in all likelihood, it's not going to serve you as well over the next few years.